Right.
All right. Cory, what's a buy and hold?
Buy and hold is just going to be a real simple strategy. In essence, this is just going to be a property that you're intending to keep for 12 months or more, right? This is a long-term play. This is not a short-term play versus, say, a flip kind of project that you might be getting into. This is really meant to be that 1 year plus kind of property you're going to sit on.
Yep. And some people might call that an income property, rental property. This is where we get into the passive part of passive income, although you're going to find it's not necessarily passive being a landlord, right? But this is where we're getting the benefits of passive income real estate investing.
I was going to joke and say, like, unless you've mismanaged maybe your flip project and suddenly what was supposed to be my short project became a year plus kind of a deal. But
never.
That
never happens.
No.
Never. Anybody never messed up on a flip? Yeah. So Morgan says never. Morgan said he's never messed up on a flip.
Spades killed it. There we go. Yeah, it's a batting 1,000 right away.
One. Morgan's the best investor in the room right now. Enjoy it. Enjoy the wave, Morgan.
Hall of Fame numbers right there.
All right. So our considerations for buy and hold are going to be different from those of a fix and flip, but several of those are the same. A rule of thumb when you're looking at this is every buy and hold probably will make sense as a fix and flip, maybe not in the reverse. So when we're looking at, Cory's got some metrics, when we're looking at some of these properties, when we get into the higher price point, they're not necessarily going to cash flow. They're not going to cover your debt service because there's an upper limit on how much rent we can charge. So a $500,000 property, you're not going to find a 1%, a $5,000 rent payment for that. Does that make sense? Right? But it might make sense to go do that property because maybe the equity on it is, the exit on it's $700,000. So really one of the things we'll look at is how do we buy these things correctly?
Yeah, that's right. So a couple things to really consider out of that when we're getting into this, right? Certainly just how much cash do you have available to get into this kind of project? What's your long-term strategy overall? What's really your risk tolerance? I would say, like, who in here would consider themselves like a higher tolerance for risk? Cool.
And who are my low risk tolerance people?
The lenders.
All right. Who's got, let's say, a medium risk tolerance, right? They're willing to. All right.
Yeah. I'm pretty aggressive.
Got it. We got some risk agnostic folks in here. I love it. Not who's not sure how they feel about risk.
That's fair. Yeah.
All right. Gotcha. Baron, what's your risk tolerance? I'm curious. I was waiting for you to see where you raised your hand. I was watching you and David here. Yes.
Depends on the circumstances. Well,
Okay.
you put me in the spot now. I mean, it depends on, if I'm over leveraged, or it depends on the circumstances, the markets. I'm usually, my background is in engineering, so I usually take calculated risk. But there are uncertainties in the market, it makes it a little complicated when you try to invest bigger properties like multifamilies. So.
I love it because my engineer gave me an answer that's a calculus answer, right? He's doing multivariable. He's like, hey, it's going to depend, if I heard this correctly, how over leveraged I am. So my risk tolerance is varying according to my personal investment strategy, right? How much cash do I have on hand? How leveraged am I? That variable is going to affect this other variable of how much calculated risk am I able to take? If I'm sitting on tons of cash, well, then I've got lots of opportunities, right? Hey, I could just buy this thing outright cash. If it's a nightmare, I can do some other things here. I'm not as concerned about high interest rates, right? I may be able to make a stronger offer. But man, if I'm really over leveraged, I might have to pass on the greatest deal of all time because it just doesn't make any sense. I can't take on one more property that might bring down the whole house of cards. So
I would say time could be a factor in that as well, right? Like maybe where you're at in life and just in general. Typically what I found is like our more seasoned investors, so to say have been around for a while, have a lot lower tolerance for risk because there's just, you don't have as much time to recover. Things go like sideways. Things go sideways when you're like in your early 20s, kind of figuring this stuff out. Awesome. You got a lot of time to still like recover versus say if you're already facing retirement or into retirement age, then it doesn't make sense as much to really take like a high risk on that because you're really risking losing a lot and getting set back a lot further.
That's a great answer. Yeah, right. So I'm looking at where I am in time. There's a guy that ran Keller Williams. He bought so Keller Williams has a franchise model. So they sold territories. So he bought the entire Southeast region and he grew it into, I don't know, like the 6th biggest real estate company by agent count. Might have waxed. This was like 2 years ago. He had that. He had busted out. He was 55 when he did that. He had busted out several times. But when he was 30, he went under as a builder. Like he's not making the same moves. Like he had to do it at 55 because he busted out again. He's not making those same moves at 55. That's why he went into there was a lot less downside in buying the real estate franchise business than going out and being a spec builder again, right? Because he lost his shirt when the market turned on him, like a lot of people did in 2007, 2008. So let's run through a couple of things here. Cory, I thought the first one was there. It says, how much free cash do you have to market for? The market one jumped out at me. Buy, renovate, hold, and rent the property, because all of those, there's costs associated with it, right? We're going to break down the numbers, but.
Yeah, I mean, so certainly there's just your acquisition cost that can go into when we talk about like marketing for it. So just what sources am I going out to spend money on to then go find these deals? Maybe is that direct mail? Maybe I'm hiring a VA or like a phone prospecting service. Maybe you yourself are doing it. So there's some costs associated with that. Then you've certainly got your capital to go in and purchase a property, renovate it, sit on it even during that time, right? There's like holding costs through that you're gonna have to pay. And then ultimately get it rented and say refinance on this strategy.
So for you, this next question is, for your strategy, are you more appreciation focused or are you more cash flow focused? If you had to pick one to prioritize.
One to prioritize.
Yeah.
Probably initially cash flow, because that's at least going to like cover my base right off the bat. I know that if it pencils out where I need it to, then I'm good with that. My personal, like how I look at that is I need a property to service the debt. That's our principal, interest, taxes, and insurance, and $500 a month, like in profit after that. That's my basis for risk tolerance. I've seen some people go lower than that. Some people are higher. That's mine.
So who's more cash flow focused in here? Who's anybody appreciation focused? Baron's appreciation focused. Fantastic, right? If you're getting started, cash flow, right? Unless I can come in as a joint venture partner or something where I'm limiting my output, I'm taking less. Maybe I'm going to someone in the room. Anybody open to a joint partnership if I had a deal? Awesome. So I'm going to one of those people that have capital and I'm saying, hey, can I participate in this deal? Maybe for me that makes sense. I couldn't take it down, but instead of whiffing on it, I bring it to someone else. I get a piece of this appreciation. Maybe I get a bigger piece because I'm willing to forego immediate cash. That's one way to do it. But if I'm new, a cash flow focus is often what we're going to see, because that cash flow focus is going to get us to the journey you've been on, right, Cory? Hey, how do I get to where I can at least replace my expenses with passive cash flow? Once I hit that unlocks a lot of things in life.
That's right.
You have a baby coming up here. Now, Cory, hey, I can go take paternity leave even as an agent, right?
Yeah, that's right. Yeah,
because my expenses are covered. I'm cash flow neutral, right? And then how do I get to double that is the next goal. And once I've got to double that, right, then I'm going, how do I 10X that? And if I can 10X that, that's that freedom number, right? Then we're talking about having enough cash flow to really fund my retirement. We break down those numbers another time in terms of an exit. Does that make sense, y'all? Yeah, cool. So that's what that longer term strategy.
Yep.
I'm gonna ask you this one. This one on the bottom is probably the most important. Anybody a reformed fix and flipper? Anybody over that game? Anybody else? Anybody still doing fix and flips? I wish you could see everyone in the back. Lance, just give me one of these. He's like, oh.
Yes.
Yeah, right? Because we might need to in this market right now, but if we had the choice, so what's my tolerance for dealing with rehabs, for dealing with contractors? Anybody love dealing with contractors? I had the privilege. I love it. I love it. So Josie loves dealing with contractors. If you need a project manager, Josie is someone you might be able to talk to. You can steal her away. She's got some experience. I've had the privilege, Cory, of being, I think 3 of the least 5 respected. I've been a contractor. I've been a mortgage broker. I've been a realtor. I just got to check off used car salesman and attorney, and I've been 5 for 5 on the least respected professions. Right. I love contractors and I love realtors, and mortgage brokers are okay, guys.
Yeah.
No, I like mortgage brokers. But tenants, buyers, agents, right? Like that's something to keep in mind when we've talked about this before. What's your preference? We talk about signal to noise, you know?
Yeah, I would agree. I would say like if you're not really tolerant of say working with all of those different pieces, it's a whole other topic. But then you might as well just start looking into syndications, REITs, things like that you can just kind of put your money into, let it do its thing. You believe in the power of real estate, but you don't necessarily want to be the one to manage these projects all the way through, or just have any insight into that.
Got you. So where do you want to own? We've talked about this before, right? Zone. So how do I zero in on a market? How do I own the mind share in that market so I dominate that niche? How do I build out a network around what I'm looking to do? And then how do I enhance like that property? How do I enhance my network? So where do I want to go own and hold rental properties? Cory's selling one right now because it's not in his niche. He's just got that duplex we've been talking about because it's up in Halls and he doesn't want to be in Halls, right?
That's right.
Yeah.
Yep.
How long do you intend to keep a rental investment?
Yeah. Personally, no less than 5 years. I'm sitting on anything I own. Really, the stuff I like to buy, I intend on really sitting on for 10 plus when I buy it, like for my particular strategies. But yeah, I would say like that's certainly a question to ask is just how long do you plan on wanting to sit on this thing? Mm-hmm. Right.
We have any property managers in the room today? Do they?
I work for property manager.
You do?
Yes. I'm a business development manager for PMI Knoxville.
PMI Knoxville's in the house here, but anybody else dabbled in property management? I've done property management. So I see Rachel in the back there. I see David nodding his head there. You know, property managers earn their money. They earn their money. So how are you going to manage those first few properties? Do you have a system in place to do so? The great news is there's lots of tools. We'll talk about those later, but do you have a system to do that? And, you know, do I have a system that's going to work for when I scale past one? How am I going to manage 10 properties?
Yep. Understanding what your rate of return is going to be on there. What do you get from your other investments? What are you expecting out of these investments in real estate? Again, this just kind of goes back to your risk tolerance and where you believe makes sense for you to go invest your dollars.
Where else are we investing right now in this market besides real estate? Anybody still investing in crypto? I see Will nodding his head. Tristan, the hall, yeah. Josie, great. What about stocks? Anybody investing in stocks? Anybody got a nice Vanguard index fund? They got some money parked in? Yeah. See Michael raising his hand back there. Great. What else am I missing? Is there anything, other asset classes you like to invest in? Bonds? What's that?
Startup company.
Startups. Well, you're doing some equity investing in a startup? Okay. I love it. You're diversified here. But you want to compare this, right? Of like, where can my money go in the market so I can make a good decision on where am I putting this? We like real estate because we can control more of the outcome. You know, if I was brand new and I didn't know all of this, then I might want to take a good look at, where else could I get my money? Could I get something with a more secured return and less risk?
Yep.
And then what rate of appreciation do you expect from real estate?
Yeah, for sure. Historically, right, when we look at the trend line of real estate through all the ups and downs, you see a historical average of about 4% per year of appreciation on that. So while we don't count on the appreciation when we're initially doing our analysis on a property, you can't ignore it, right? It is there. You know that if you're playing the buy and hold strategy long term, you're going to see a positive return on your investment. It's just when you cash out, where are you in relation to the market versus where you started?
Ooh, so there's a good, so when we say 4% return, let's keep this in context, right? It's a 4% return if you go back to the mid 70s. If you go back to the mid 70s and you draw a line from there until now, you'll see that a 4% line year over year, real estate has always been above that, right? Now, however, there's been some big swings and some big crashes in there. So that doesn't mean if you're buying at the peak of the market, if you bought in 2006, you're not getting a 4% return on your money in the short term. Real estate has never gone down, or the stock market over a 9-year period. Go check my math on this. So if you are holding for a decade or longer, if you have the ability to do so, if you have adequate reserves, right? If you have the skill set to navigate the problems that might arise, maybe I got a bad tenant, maybe I've got some unexpected repairs, to have access to capital and resources, there's a reason why this is the holy grail, why we're all here, right? It's the keystone of building long-term assets. There's lots of advantages to it. but I've got to look at where I'm buying. Is there anybody now that we've had over 10% appreciation, that would like to go back and buy a year ago when things felt like they're overpriced?
For sure.
Okay, just me. I love it.
I'm building the time machine right now in my garage, dude. I'm going. Absolutely.
Would anybody go back and buy I'd go back and buy 2007 prices if I could.
Yeah, 100%.
Right? You look like, better for 2008, but you look like a genius right now if you could buy your whole portfolio in 2007 because the market's risen so much. Long term, anybody feel bearish about the market in 10 years? Everybody feel pretty bullish about where it should be in 10 years?
100%.
Yeah, Mateo.
I feel bearish.
You feel like bearish, like it's going to go down?
I feel like it's going to go up.
Yeah. You know what? I'm breaking my own rule. Bearish and bullish. If you go to Wall Street, bears, people think the market's going to go down. Bulls think the market's going to go up. That's why CNBC always shows the bull. They never show the bear, right? Because Jim Cramer wants you to buy everything. Because, they can't even price in that the market could possibly go down.
No.
So let's talk about...
Yeah, let's talk about just
buy and hold, Cory.
let's talk about Knoxville specifically, right? When we're looking at kind of the buy and hold or even just like the BRRRR strategy, what really fits into there? Like we personally really look for these homes that are have our ARV or after repair value being anywhere between $250,000 and $350,000. That's going to be a really nice, comfortable range where you're still going to be able to have a nice property that's not like over improved and the math is still going to pencil for you when it comes to actually like exit and sit on this thing for a rental. Because we do recognize that there seems to be an upper threshold of our rental range here in Knoxville, which ranges anywhere between $2,000, $2,500 a month seems to be kind of that upper range of it. Getting beyond that, we typically have to get a little bit more creative in terms of our renting strategy. That could be your Airbnb, your midterm rental, students, right? We've kind of talked a little bit about that stuff before, but that tends to be our range. So if we can keep our after repair value on these homes or properties to be in between that 250 and 350 range, you should have a really comfortable margin when it comes to actually renting it out. Now, ones on the low end of that spectrum, you might be able to, you might attract a not so great tenant that can require a little bit more maintenance or upkeep to some of your properties. And certainly again, your high end, it's probably gonna be nearly impossible to really find something that's gonna pencil out and cash flow for you.
So one of the things I was having this conversation with Rob Chavez that started great about this. He's in the DC area. And so there's people there that have had a lot of success in that market, right? DC, Baltimore, in doing Section 8 housing or doing, right, at scale. Hey, I'm going to get enough properties. And when I get enough properties, I got a professional management team in here. I can provide a greater service there, and this is really making sense for us because it's a niche not everyone else is going out to. And what he found is typically those were older properties. And as he went farther along with those older properties at scale, he didn't get the escape velocity he thought, right? Hey, I'm going to get more units. When I get more units, right, this is going to get easier. Now I've got 100 properties and I've got to replace 20 ACs this year, right? I've got 20 roof replacements. I've got more of these tenant calls. And so they ended up liquidating that portfolio and going towards more build to rent. Newer. It just was an easier product for them. It didn't scale in some of the exact same way. So have had success with that. I've managed Section 8, and helped someone manage Section 8 property before. And yet we prefer to be right in that 250 to 350. It's right below the median price point. We just find that we find properties there where there's always problems with properties. Those are problems that we feel well suited. Right? We're able to attract some tenants that might have families or kids or in more desirable areas. And because they're in more desirable areas, we can screen tenants a little easier, right? Which makes the whole thing make more sense for us, right? We're looking at it as a whole, not just as a cash flow number, right? Because there's also a lot more, we found on the lower end rent, we have more turnover. So we got to factor in our turnover as well. Anybody, we've been talking for a while. Anybody got any feedback? We say anything that sounds crazy? Anybody love the low end? I'll give a counterpoint. I saw Adrian Smood come, Lifestyle REI, if you haven't checked him out. All he does, his wife buys mobile homes. He's got great branding, and he really convinced me like that mobile, if you want cash flow, you should be looking hard at mobile homes. Nothing makes more sense than mobile homes. He walked me through his model. He does the bare minimum on these. He will lease out these mobile homes to contractors because he's like, hey, they can fix it themselves. They're not calling me. And by me not going in and renovating that property and updating everything, I'm able to deliver a rental product at less than $1,000. I'm able to hit a niche where no one does, so people can have a place that they can afford to live in. And they'd rather have a place that's gonna fit their budget, and they can take care of a leaky sink on their own, or they don't care what the outside of the trailer looks like as long as it's functional. And I thought that was kind of interesting. He said he had a lot of success with that play. Yeah. So Cory, if I've acquired this property, man, what am I doing when I get to those properties? What do you like to do on your rentals?
Ideally, I'm really just trying to fix what's broken. I'm going to cover just some of the basics as much as I can. Painting my cabinets, used appliances, going to some of like the wholesale surplus stores for my flooring, if I can get it. Laminate countertops. This doesn't need to be anything like fancy. This is just going to be a more of a rental grade product. Only exception in that I would say is just if you're already approaching something that you're just going to have to gut and replace everything, then at that point it can make sense to go ahead back, make things a little bit more bulletproof, so to speak. Your laminate flooring, your granite countertops. You can still find some of these products at a pretty low expense overall that will still give you a very nice finish. You can still create great rental income off of that. That'll typically also help you on your exit when you want to go kind of refinance out of this strategy.
And the reason we're doing that is because if I have to come in and I have to totally gut a kitchen, for example, my labor cost is going to be the same whether I go in back with a laminate or a butcher block or if I go in with like a granite countertop. Does that make sense? So paying the additional for the materials makes sense there. My buddy Jason McDaniel, if you know Jason runs one of the other real estate investing groups in here, Knoxville's Best. He liked to come in. He fully renovated all of those. He had a silent partner, right? Where he was coming in, he was doing the acquisition. They had capital, they had an ownership structure. They wanted to do a BRRRR strategy in an appreciating market, right? They were buying right before COVID. And he said, hey, I'm going in on the front end and I'm fully renovating these on the front end just because I like the tenant that I'm getting. I don't want to have to go back and deal with it. He was doing a lot of work themselves. So there's some argument you can make for that because we're in a very strongly appreciating market. So who here likes to come in and just do, right, let's call it a landlord grade product, something that's going to make sense, that's going to be, anybody like to come in and do a fully finished, they like to put granite in there. Awesome, I love it. David, why do you like to do granite versus doing right? Hey, we're just going to come in and fix what's broken and maybe hold our costs down.
Because there's amazing marketing strategy when you say it's got granite. I don't care whether it's an $1,100 unit or a $5,000.
I don't. If you know me, you know that I like to spend money, and Cory is frugal. And if you compare our balance sheets, you will see that Cory's strategy is far more successful, right? One of us is not taking paternity leave this year, right? So, but yeah, I like delivering a finished product. However, right, we're also professional agents and I have faith and I've seen over and over again, hey man, I know how to sell the best house on the street. If I'm brand new, I want to get some feedback before I come in there and have the best house on the street. We just ran into this. We did a home over on Washington and Cherry, right? Brand new construction, nothing touched this. Anybody see 2624 Washington Avenue? Yeah, right? Nothing. In terms of the finishes, nothing touched it. We probably over-improved it. There was a max on what we could get, and we could have hit the same thing by there. I should have taken out like half of that. We had a designer kitchen in there. We just circular stamped driveway. There's just stuff that we didn't need to do. It was really kind of a model for us, but we could have pulled back on half of that. Luckily, we were able to sell that. I pivoted and sold it to an investor. But if I was brand new, I might have really got out over our skis, or if we didn't have, weren't contractors and could control it, we could have got ourselves in a little trouble there over improving.
Yeah, it would have made the exit a lot harder at that point. Right.
Ooh,
Yeah.
Property management.
Considering property management, right? One of those, that's a big one for a lot of people, whether you're new, whether you've been around and maybe you're just becoming a tired landlord. Do I want to self-manage? Do I want to hire management?
Ooh.
And what does that look for me on either side of that?
Who's on team self-management? Yeah. Awesome. And who's got a killer property manager and they don't have to deal with the property themselves?
Chris, Nathan. All right, raise your hands.
Baron's got one. Amber's got a property manager. Awesome. Why do you who raised a hand? Why do you self-manage? Will, here you go.
I have time and I don't have money.
I love it. That's a great answer.
I'm curious, David.
Yeah.
I'm curious to David.
Wow.
I have the time and I have the money.
If you haven't met David, David's also cheating because David is a professional, at this and has managed lots of units, right? Baron, you said you use a property manager, right? Yeah. Why do you use a property manager?
I have money. I don't have time.
So there we go. We could overcomplicate it. I don't know that we need to. Anybody else? Anybody else been a property manager? I've been a property manager. I'll share my experience because I think it's useful, right? So I am a mortgage broker. It's 2005 down in Tampa. By 2007, the market is like, the wheels were coming off. We could all see it, by the way. Anyone tells you they didn't know what was happening, was not there. We knew what was happening. I could read blogs and knew what was happening. Like the warning signs were there. It didn't just come out of nowhere if you were in the industry. My mom knew what was happening. She was an underwriter, right? And she's like, I'm doing all the underwriting when banks are selling packages of loans to other banks. And man, it's so funny. Only McDonald's managers are buying houses now, right? Because it's stated income, stated employment. They're making up job titles, so everyone's a manager wherever they're buying. Anyways, I end up needing a job. I go work for a property manager. Studied property management in Tampa, downtown Tampa, luxury property management. Then I've come up here. We did commercial property management and had a friend of ours that was in a jam. We ended up taking over a 19-unit multifamily up here in Fountain City that had fake rent rolls. The seller had pulled all the good tenants out, right? Kristen that runs Jacob Play helped her set up her company here. It's a skill doing this thing. If you're going to go for multi, keep in mind, right? You're running a little community there. So the advantage of there's all these scales, you only have one property to watch. A disadvantage is you've got one tenant affects the other tenants. So when the one tenant has drama, when there's a domestic issue, something there, when they bring home bed bugs because they're buying used furniture.
Say bugs, yeah.
Yeah. I lived in an apartment. I got bed bugs. There's a really nice single mom. Somebody gave her some stuff, and then we got bed bugs in my apartment when I was newly divorced, right? Because somebody gave her some stuff with bed bugs, right? So we're going to handle marketing. We're going to handle tenant screening, credit and background checks, rent collection. A good property manager should be making this easy for you. And if they're screening a tenant correctly and they're keeping the property filled, they should, in my opinion, cover the cost of their own expense, right? Because the vacancy is going to kill me having I'm losing $1,750 in income, right? And a good property manager has enough units, wants to keep the property filled because they don't want the headache of having to go out. They incur all of their expenses when they're screening and getting a new tenant. That's when they have to go show it. So a good property manager wants the same thing as you, is nope, I want to keep it rolling over and keep collecting my income and hold down my expenses and hold down my time, right?
Yeah. If you do, because you should get your detailed monthly expenses out of that, incur less vacancy. If you do want to manage yourself, right? There are a couple of platforms out there. We've got avail.co. I personally use that. Turbo Tenant was a great one that was recommended last year. That one I really like because that will report to the credit bureaus. That can work very positively. For you as the landlord, that can also be very positive for your tenant because a vast majority of landlords do not report those rent payments to the credit bureaus. And so that's how some people can be just perpetually stuck in a cycle of renting because that's not getting reported to a credit agency, right? They might have had the car that went to crap on them, something along those lines. I really like that product just because it does have that ability to that. And that's certainly one that kind of hangs guess, over the tenant's head to a degree, right? As if they're not paying, this is getting reported, it's going to negatively impact them. Apartments.com and Buildium are a couple other ones that we like to recommend.
So, and I've used Propertyware, I've used Folio, I've looked at Buildium, I've come in for Jacob Lay and like looked at all of them on the market, did a white paper on this and rolled them into, we chose Propertyware. Those are going to be enterprise solutions. So Appfolio, Propertyware, you need at least 50 units for those to make any sense, up to 250, like, right? Buildium is interesting. It's a full-fledged, you could scale with that. It's $55 a month to get started. And there's some, on the marketing side and the tenant management side and the tenant portal side, it's got some interesting concepts, right? Where you can go out and market it right off and manage it there. So it's a pretty robust product. I'd take a look at that one, just depending on your profile of what your tenant profile is. That one, and then Avail has got some really strong ACH, payment collection options.
Yeah, I was going to say
as well.
that's the one I personally use. This isn't like a shameless plug or anything. I'm just going to tell people like what I use. I use Avail. It's really nice for me. It's kind of a one-stop platform. I can market my property through there. That's typically syndicated through like Realtor.com. I can build out lease templates. It'll give you some templates that you can then like edit as you'd like. You can set up direct deposits. It sends auto reminders to my tenants. So it's usually like a week out, a day out, day of, day late. Like there's constantly notifications. They can submit maintenance tickets through that. So I don't take any of like the dreaded like late night phone calls or any of that, the kind of the horror stories that people hear. It's just, they go into the app, they submit a maintenance ticket. Hey, my garbage disposal broke. Awesome. I get that as a notification on my phone as well as an email, and we can move on and handle it from there. So,
similar platform to Buildium.
Solid.
Yeah.
Cost of that's super low. I think it's somewhere around like $5 a month or something like that. Like well worth it for me just to go ahead and use it through that. Yeah.
So couple quick tips. We like to keep our rent below market rate. When I keep my rent below market rate, same thing with your pricing, right? Hey, I'm going to go ask 300 for the house. They can talk me down to 275. Cool. You're going to miss all the people that would have, like you'll make less money, right? When I keep it below market rate, I've got a lot more options for my tenants. When I have more options, I make better choices on who I rent properties to, right? That's how I prevent myself from compromising my judgment on a tenant because I have options. I'm not just picking and choosing. If number one way to screen tenants, if you want a crazy rule of thumb, sat there, we're in an interview with someone. This guy managed like 1,200 properties. He managed thousands over his lifetime. He said his number one hack was he would just look at their car, right? If you can see the floorboards in their car, and if they're taking care of their car, there's a good chance they're going to take care of their property. If you can't see the floorboards in their car, sorry, realtors, I know we're all feeling personally attacked here, right? Then that's an indication of how they're going to keep your property as well, right? Who doesn't want a nice OCD tenant?
Yeah, no doubt.
Yeah, fantastic.
Yeah, I would say that is a good point to make. It's just if you can be slightly below market rents in there, you're definitely going to get a bigger application part, and you're running a lot less of a risk of that tenant like leaving you because they can save $50 a month by just going like right down the street. So if I'm just priced right from the jump, I typically like to sign 2-year leases if I can help it, like on the front end, and then try to just renew those like thereafter.
Always run credit and background checks.
Always run credit and background checks.
Oh, so some of those platforms can run credit and background checks, and if you're uncomfortable with this, hire a property manager. You're running a business, right? We are both charitable individuals. Our business funds are charitable endeavors, right? And we've tried it the other way. When we've done it the other way, it just doesn't work. When we're like paying for repairs out of our pocket or it just doesn't work. It's not sustainable in the long run. That's a lesson that was drilled into me. Someone said, hey, I could go give this money now and I'd run out of it, or I could build a business that kicks off this amount of income like an endowment and I could give that every single year, right? So never accept partial payment. Anybody got any thoughts on that one? That's kind of a hot take.
Oh, that's a big one. Definitely don't accept partial payments. As somebody who's accepted partial payments before, like do not accept partial payments.
Why don't you accept partial payments?
Dude, it's just because it's kind of the whole, like, what's the story? Like if you give a mouse a cookie, 100%, that's exactly how it goes every single time. Differs from tenants. started doing partial payments. I'll pay you half, then I'll pay half, and then suddenly that would like drag on. It was always seeming like almost like 2 weeks ish behind on like the money, the income there. And inevitably, like as it came time to renew that lease, they were already having like a hard time, like just making it, obviously. So then at that point, it just came down to a decision to just, hey, we're not really going to renew this. I actually renewed it for a shorter term, like 5 or 6 months, just to get me into the spring, summer time for leasing. And then that's when we turned that property over. So I gave them essentially 6 months notice. I'm not going to renew your lease like when this comes through at that point. And then they moved on and I moved on. So don't do it.
DL.
Hey guys, DL with Knoxville Home Guys. Tennessee Home Guys sounds good too, though.
Okay.
Just hey, we might move there.
ahead and get
you
that.
Know, you wait, then
Somebody get
give
on
us
GoDaddy
5
and get
years. I had a question about screening tenants. This obviously caught my eye because of recently going through the process of using Zillow for the first time to advertise my property and take applications and so forth. And they hit you with these messages about, Fair Housing Act and so forth and so on. It kind of stresses you out about like, what does it really look like to give this particular person a fair opportunity to rent my property? Am I wronging them, setting myself up for failure by telling them no if I don't actually like the first person who fills out an application? On and on. Does it make sense? So how do you get 15 people apply, but you really like the 15th person?
Sure.
But not the first person, but you haven't vetted them all yet.
Yeah, I would say, Tennessee's a very like landlord friendly state. And so there's a lot of things there that kind of protect you as the landlord. It's probably one of the most landlord friendly states, I believe, in the country at this point. So
I could jump in here with,
Sure.
Right?
Sure.
So here's something, especially if you're an agent, right? If you're an agent, you got to do this anyways. But if you're running this game here, we have a Fair Housing Act. The reason why we have a Fair Housing Act, and this is going to sound, it's not controversial, it's just factual. Unfortunately, real estate is one of the few places where you can see we have had explicitly racist policies. There are housing covenants where you can go look at these, and on the deed it still says we can't sell to a certain ethnic group, right? We won't sell to African Americans or something, right? So that's why this exists. Redlining practices like that. There's a racial income gap in this country directly tied towards home ownership, which again, unfortunately, everything's so crazy that sounds like a controversial statement. It just kind of is, in my opinion, right? Pretty clearly marked. What you can do is have a policy. Write down your policy for tenant screening, right? And then apply it consistently. I see some nodding. As long as I am applying it consistently, I am fine. Because I'm not making a decision based on a protected class. So what are my protected class? I'm not making a decision based on someone's ethnicity. I'm not making, depending on the area. I wasn't clear if they added this federally about, sexual orientation or family status, right? I can't discriminate against someone, who's based on their family status alone, right? But I can certainly look at their ability to pay. I can look at some of those right? I can look at their past history. I can look at those references. Those are all consistent, right? I might run into some trouble if, hey, wow, I don't call Jose's references, but I call all of Cory's references, right? Or I don't even ask Cory for references because I'm not being consistent in my practices. So just having a policy that I'm following consistently, that makes sense, that I would feel comfortable articulating to somebody, run it by a friend or something. That's my advice on how you could stay clear. There's really good guidance in on this. Like the HUD has like a good pamphlet on the fair housing policy and like what it is and how to comply with it, right? Because we are still seeing they're running tests. This happened in New York. They've run tests and they send 2 different groups in and there's still housing discrimination happening. Just solely based off of like appearance, not off of something like practical, like stuff that no matter where we all feel about this, I don't want to be controversial ever. We serve everybody, but just stuff where we all look at that and go, hey, that's not fair. That doesn't make any sense. It's not a question of like, man, I don't really want to cut someone a break that's constantly late on their rent, right?
Yeah.
Does that answer that question? I know I'm glad you asked it. It's a real question. Yeah.
I was just going to add to that, with the partial payment. With a partial payment, you're really getting into some fair housing issues with that. Because if that got around and a tenant knows that, hey, you accepted Joey's rent late, but now you can't accept mine. Why? Because I'm, African American or I'm Caucasian or whatever. They could blame it on race, which is then fair housing. So it could get you sued.
And fair housing isn't all, there's, I believe, 7 categories. I don't want to rattle them off from memory and miss something, right? But just, having a consistent policy. And I would just say the biggest reason not to accept a partial payment, to think about this in another way, I'm just avoiding a fierce conversation I have to have. I've had to come into a place, take it over. I told you all the rent rolls were falsified. So I had to go evict a bunch of people. And I've been able to go evict people down at the courthouse, have them shake my hand and thank me because I treated them with dignity and respect. But it's had an honest conversation about the fact like, hey, bud, you're 4 months behind. Like we've got to collect some rent. I don't think you're going to be able to catch up. Let's work something out. So, maybe we're not going to come after you to get you on the way into something that you can afford, because what they were in was unsustainable. And that's really it. If I'm having partial payments, man, they're getting into something that's unsustainable. Let's address this thing on the front end, so we're not just engaging in a cycle that's not going to serve that tenant ultimately.
Question.
Just going to add on that my understanding is that if you accept the partial payment, it sort of resets the clock on your eviction timeline. And that can make it complicated when things do get sort of out of hand. And one of the rules I use is if a tenant's more than a month behind and they have no plan for making full payment, they're not going to catch up. So that's just something you can set your own thresholds, but that's typically my experience.
So if you couldn't hear Jason, it's an excellent point, right? That when I accept a partial payment, I am limiting my eviction process. Again, I should have a process that I am following consistently. So hey, I have late rent. I am putting out my notice, right? Because what I want to plan on where I get into trouble is I'm being nice. I'm being reasonable. Everything should work out. That next thing doesn't come through. I have been the person on the other end of this. I've been a bad tenant, right? And now I'm far behind, whereas I can always start that process. And great, hey, fantastic. Just so you know, this is the paperwork I have to follow up on. I know you're going to make payment on the 15th, but I'm doing the same thing every single time. I'm putting my notice and I'm serving that when I should, so that way I can limit my vacancy, because the vacancies are going to eat me up. Last one here, and we'll move on.
I was going to ask, what kind of stipulations do you guys typically take to help yourself, protect yourself whenever you do get a bad tenant? You vetted them, and then they just ended up not working out. They're behind on payments. They're trashing the property or whatever. How do you go about how do you protect yourself to say hey, you are evicted at this point, or do you just have to go through a certain process?
So I don't want to get too into what you're really asking. So you're asking, hey, if I have a problem tenant, I'm just evicting. So what I'm doing is when I am serving my 10-day notice or my 3-day notice, right? For rent, whatever I've got in this lease. I haven't done this in a while, so don't quote me there. I'm starting that eviction process, and I'm just evicting that person. The protection I'm really doing is how I wrote my lease and how I screened my tenant.
That's what I was going to say.
So just clauses in the lease.
It's all on the front end, right? It's just like a contract. An agreement should be called a disagreement, because it only matters when you're going to have a disagreement, right? And somebody drops a garage on your house, right? So when it comes down to these, there's just some simple provisions, and they should be written in a way where both you and the tenant understand exactly what's going on.
Yeah.
It's not a problem, but if there's an issue here, right, we're going to do this because we're going to move you to a place that's going to fit your budget or your needs, right? Because I've got a mortgage. It just is what it is. Yeah. As long as I'm being consistent.
Yeah.
So is there an agreement between the renter and the property owner that says if you do more than $5,000 worth of damage within a certain amount of time, you break your lease, or is it just changed?
That's going to be lease specific. I'm happy to just kind of dive deeper with you after the fact, because it really is just going to be what the terms of your lease are, what the inspections look like. There are some provisions one can put in place as far as recouping any damages, things like that. I'm happy to go deep. We can kind of ramp in that.
So I guess your question was just like, is there a provision I put in place where if someone is creating massive property damage, they violate the terms of their lease? I would imagine the lease language would cover that. And then it's going to be, again, me reverting to small claims court or something. Like if I am getting to that place, I am way behind the 8 ball.
Yeah.
Right? I have already lost. I am not recouping that money. I'm getting a judgment that's never going to get paid.
That's never.
Is my experience. Yeah.
Yeah, you're just chasing people at that point.
Awesome. Cool. All right, guys.
Let's kind of rip through some numbers really fast. Loan considerations. Most investment loans are going to typically require somewhere between 20 and 25% equity on the purchase price or the appraised value. This can be done up to 10 properties in total. These are using conforming Fannie Freddie loans. So that's just going to be your run-of-the-mill investment.
We've talked about this before, like a conforming loan is just going to be a loan that could be bought by a government agency. Sometimes there's what's called an overlay, where Regions Bank, for example, has their own, these are the minimum guidelines, and we have this additional guideline, right? But when we say conforming loan, that's just going to be, hey, I can put 5% down on that property, right? This we're talking on the investment side, right? So we can only do up to 10 on a Fannie, but we've got some options. We got some lenders to get creative where you can own more than 10, using some different strategies.
That's right. Yep. Lenders just going to typically want to see about 6 months of what we call PITI. That's principal, interest, tax, and insurance. They'd like to see you have about 6 months worth of reserves covered there. So if it's a $2,000 note that you're responsible for paying, they'd like to see you have about 12 grand in backing capital, just to know that you've got some cushion there. Cushion on it. Yep.
And then 70% loan to value. So what we're talking about is what's the value of my property. So that's going to be the contract price. If it's new construction, it would be maybe the appraised value if I was getting a new construction loan, but it's going to be my contract price. So if the purchase price is $200,000, right, it's $140,000 loan that I could get. Any questions on any of this? There's no silly questions. Cool.
Pretty straightforward.
All right. The BRRRR strategy. What's the BRRRR strategy?
The famed BRRRR strategy, right? That buy, renovate, rents, refinance, repeat model, right? It's kind of 5 steps. So quick question. Can it still be done? Quick poll of the room. Can you still BRRRR right now? Can you not BRRRR right now? I'm curious. Who thinks you can still BRRRR right now in this market?
Oh, I love it.
Surprising amount of hands.
I love it.
Right. So who would say no, that you cannot BRRRR in this market right now? Kind of. I would really say, right, kind of depends. Depends on the deal. Depends on what you're buying.
Can I ask another question?
Sure.
Who thinks you can BRRRR right now without leaving money in the property?
Good question.
Whoa, Morgan's our two creative lenders. That's it. That's it. These guys work the refs, so it's Morgan and Nathan are the only people that were like, yeah, of course you can. Everybody else, who's leaving at least 5% in the property? Yeah. Who's leaving at least 10% in properties right now? That's what we had that conversation, right?
Yeah,
Cory?
For sure.
Well, yours is like 15, right?
About 15%.
You left 15 in on Hannah. Who's leaving more than 20% in properties? Doesn't really make sense, right?
Yeah,
for the strategy. Yeah. So can it still be done? We're gonna break down the numbers for you. We're gonna go all in there on an example. So, all right, Cory.
Yeah. So the goal, right, in all this is to execute this like perfectly, is to be able to buy this distressed property where both your renovation and your acquisition costs are no more than 75% of that ARV, aka the after repair value.
What does after repair value mean in plain language? Because I'm not going to raise my hand because this is my very first. What is that?
Sure. That's really just how much the property's worth when it's fixed up.
Yeah. Right. So I'm going to come in, I'm going to buy that asset once it's fixed up because I've looked at some comps in the area. What's my property worth? Because that's going to be the basis for my exit strategy, whether that's a sale because I end up doing a fix and flip, or whether I'm refinancing, right? That appraised value is going to be the benchmark on which they calculate my new loan. So we've gone through that before. You go back, watch our how to estimate renovations. What's the max that most lenders have that you can pull back out?
Usually it's around 75% is kind of the rule of thumb. I would say that probably depends to a degree just on some of your experience in the space, your credit capacity, collateral you've talked about before, is going to play a factor into that. So that's why I would just like to give some basic frameworks here. 75% is going to be a very solid way to look at this. The total amount you're wanting to borrow against this.
Anybody got a sick deal where they're getting more than that? Is that way off, Morgan and Nathan? Or is that a good benchmark when we're planning? 75%, just yay or nay? I know you're going to say it depends, but just, is that?
I mean, there's a few out there at 80, but they all have longer seasons.
Got it. So Morgan said there's a few out there at 80%. They all have longer seasoning, right? So when you hear a seasoning requirement, that's how long you need to own the asset in your name before you could refinance. So we'll get into that. So again, when I'm planning my hold strategy, how long am I going to have to hold it in the middle before I could refinance? It might not make sense for me to hold a property for a year to get an additional 5% out of it because the carrying costs might eat that up. Does that make sense? Like when I'm paying on that initial acquisition loan, which might be a little higher because I'm using some private money perhaps. Okay. So hopefully we're able to borrow all the money needed for the deal. That'd be ideal, right? And we might get creative on that strategy.
Maybe. Yep, or more.
So some typical lender requirements.
Yeah. Typically, right, 680 credit score or better, 12 months of cash reserves set aside. Morgan just touched on that seasoning period. So you might have to sit on this thing for about 6 months before you can refinance it. Again, that can kind of depend based on like the loan product that you're looking to exit on this overall. But typically, and I don't know if the guidelines changed that a year now, actually. Lenders, correct me if I'm wrong. Thank you.
BSCR, which is not conventional, I have as low as 3 months.
So.
One lender that'll do that.
Cool. All right. So to reiterate there, so a year, if you had a conventional product, remember our conventional products have to be bought in our personal name, not through an LLC. So sometimes they've got some more attractive lower rates or something. I can get rid of my private mortgage insurance without refinancing a conventional product, right? But I can do a DSCR loan. We've talked about this before. A DSCR is a debt service coverage ratio loan. So we talk about credit, capacity, collateral. We know what credit is. Capacity is our ability to repay the loan. In this case, instead of looking at our debt to income and saying, what are our debts on our credit report versus my verifiable income, they're looking at the income potential of the property to cover that capacity portion of it. All right. And the collateral is going to be the property itself.
That's right. So rates we're typically seeing right now, conventional owner, again, depending on your credit, 6.5%, 7.5% interest rates. For your investment property, lenders can first certainly chime in. I'm hearing a lot of like 7.5%, 8% loans on some of your more just conventional products, your investment properties. Again, you can have up to 10 of those things. And then your DSCR loans can be upwards high of that, 7.5%, 8.5% or more at that point. I think typically, go to the next one, please. On those properties, those are exclusively for non-owner occupied properties. So that is almost like a commercial loan type product.
I'm gonna interrupt you. You're in your flow there, right?
I am.
Awesome, man. So we talked about that second there. And then have you used a DSCR before?
Yes.
Okay, great. And then what was the advantage for you of doing a DSCR instead of why didn't you just do like a DTI loan for yourself, Cory?
At the time I was in an interesting spot. I was actually, at the time, this is on a refinance of that historic property that I remodeled. And I had tenants lined up. It was one of those things, I probably got some bad information, honestly, from the lender I worked with at the time, because I rushed to use that product because it was like a non-income verified loan, which was cool. It was kind of a nice upside for me on there. And I did it. It was quicker. In hindsight, though, I didn't have to do it. Like I had tenants lined up. I had leases like squared away. I really could have gone and done a just conventional refinance on that one. The project took me 11 months. So, I mean, I was really well within that seasoning window at that point.
But when you initially started it, it was supposed to be a shorter term.
Yeah, it was supposed to be 4 or 5 months.
And it was going to say, hey, I would rather do a debt service credit ratio where I don't have to go explain my crazy income as an agent and document all of that and go through an underwriter. Like the difference in that was worth the difference, right? Hey, this would be a lot to go produce.
Yeah, for
and
sure.
That might be why a lot of our investors go that route, is because it can get really complicated when we start producing Schedule Ks and versus just they're not looking at any of that. And I can just they're looking at the rental.
I would say like on that typically, right, those rates can be anywhere from 1 to 2% higher than your conventional loan products in there. And so again, like for me, like I had some kind of off info because even when I underwrote the deal and I penciled out, okay, worst case scenario, if I have to refinance this and the interest rate starts with a 9, is this still going to make sense? And the reason it actually starts with a 9 is because I went with a DSCR product, and I probably could have gotten a little bit cheaper if I would have just like refinanced it like straight up. Lesson learned for me on that one. Again, still cash flows. I make some good money on that one, but certainly work with a good lender, work with somebody who can like walk you through some of those steps and weigh out some pros and cons debate like based on what your scenario is.
Let's look at a model real fast if
totally.
we can, so we're going to be intentional, giving people time to network, right? So on this one, Cory, run us through the numbers here. We already talked about what ARV is. It's 100K. Why shouldn't it exceed 75K? Is that just that rule of thumb we've talked about before?
Yeah, because I want to be able to refinance out of this, and the goal here is that I'm recouping all of my money out of this or more, so I can go and redeploy that again and again and again and again, right? That's the whole repeat portion of this. So ideally, my purchase, renovation, closing costs should not exceed $75,000 on this $100,000 property, because I want to be able to refinance and get all of my money back to go do this again.
And so what this looks like, I've got a friend, Andrew Bunkers, out in Vegas that has bought 7 properties with the same 200,000. He got some money together with his friends. They all went and did that. Andrew is willing to write 100 offers to find one property, right? Like it's all just a different game of how am I going to do this? Am I going to go cold call and prospect? Am I going to be the coolest person ever and the wholesalers like me? They want to send me the deals, right? Am I going to spend a bunch of money on there? Am I going to go spam a lot of offers? These things are possible. Like extraordinary effort yields extraordinary results. So people can still do this. But yeah, if I want to make this happen, that's my target I'm going to aim for is, okay, I've got to be able to exit at 75,000. So let's walk through this, Cory.
Yeah, that's right. So you found the deal, right? Again, perfect deal, paying $50,000. You believe that after repair value or that ARV is $100,000. You find a good private lender to go ahead and fund this deal for you. Renovations, we're going to call it $15,000 to get you just into rental condition. So again, we're not blowing this out to the nines. This is really just going to, 15 grand ain't going to cover you very far. We're just doing this for simple math. To get you into rental condition, you've got the renovation money, but you don't have maybe the acquisition money. So now you're going to go to your private lender, and who's going to charge you 1 point and 10% interest on, say, that 50K. That could be 10, that could be 12, that could be 14. Again, this is a private lender. And so there's going to be some variability there, maybe depending on which one you're working with.
Right.
And that could be more than 1 point. That could be 2, that could be 3. Again, depending on your relationship with that person, depending on your past history of doing this, you might get some little breaks into there. But for simple math here, we're going to go with a point, which is equal to 1% of that purchase price.
Yep, we're going to hear 1 point. We're doing private money lenders. We're going to hear 1 point when we talk about rate buy down, something like that, right? When you're a point on a loan, that's just going to mean 1%. That's a vernacular we're going to use in the industry. 6 months of carry. Carry is how long am I making payments on that loan, right? So how much is that going to be? $2,500, right, Cory?
$2,500 for the 6 months. So that's $50,000 at your 10% simple interest. And title fees is $750.
On the acquisition?
That's right. Yep. $1,000 for your insurance, and then utility cost for that time, $250. So there are some soft costs. That's what's filtered in there, and that is those carrying costs, the utilities that are going to go into there. Just some of the overall just maintenance and things to operate this property while you're fixing it up is where you're going to need to have some of that added capital or liquidity to use to pull this off.
Mm-hmm. And we use this for 100K to make it really simple for us, guys. We can just scale that up. We can multiply these numbers by 3. But we're using this to get this really simple math, right? If math wasn't our favorite topic. So I'm 70K all in because I spent 50K to purchase that property. I got the acquisition money from my private money guy. I'm going to cover the cost. That's going to be my skin in the game. I got my 15,000 in renovation, right? And I've got my 5,000. I might be looking at covering that too. So maybe I'm bringing 20 in cash and maybe they're covering 50. It would just depend on what those terms are. But all in, I'm $70,000 on this acquisition. Yep. So
good news, right? We're under our target of 75 grand or 75% on this, but now we've got to get out, right? Now comes the refinance part of this thing.
Hey, Cory, when do you make all your money in real estate?
When you buy it.
Yeah, exactly, right? You make all your money when you buy it. And we found some deals. We've just have sold some off-market deals in here the renovation cost wasn't this, but we are still sourcing deals that are under 100,000. So you've got to be able to refinance out of this into long-term debt. So what do we have to do to get there?
Certainly find you a tenant. That's going to be really the first one, right? The bank's going to want to know that you've actually got this thing now performing. They want to see a lease signed at the very least on there before they're going to let you do that. That's at least a commitment. It's on paper. You can then go take that to your bank when you want to start your refinance process out of this one.
Yep. And also, depending on the institution you're dealing with, they may want to see that you have a track record. So for them, a stabilized asset may be, hey, we're doing business again, right? Jason has done this before. He comes to us, he's got a rented out property, so we've got a lease that's securing this, and he's got a track record and experience doing this before. Maybe we like to see him have already collected a year worth of payments from someone. Awesome. That is a stabilized asset. An underwriter can explain that to a third party. Why did I go give a loan to Jason? Well, hey, it meets the underwriting guidelines. So awesome.
Yeah. So really at this point now, your property is going to be good. You're going to be appraised for $100,000. You feel really comfortable in that. And so that 75 LTV loan, that refinance gets you $75,000.
You're going to have $2,000 to $3,000 in closing costs, right? That's going to be title. It's going to be taxes, insurance.
Points from your lender, right? On that refinance that goes into that. So at the end of it all, what does it mean?
Got a great deal.
We got an awesome deal. All
Congratulations on finding a property for $50,000 with $15K in renovations.
Yeah. Go Central Ohio.
If you don't come in here and share that
Detroit.
win with all of us, so we can all just warm ourselves by the glow of your success.
100%.
You're holding out on us, right?
So you've hit that new appraised value of $100,000. Total investment, you're all at this point is $73,000 after your new closing costs. So we're left with a nice nest egg here, $27,000 in total equity. Ooh. Principal interest on that $75,000 loan total, roughly, again, playing with some math here, $525 a month, plus your taxes and insurance. That's that PITI number we talked about. $700 a month in total holding costs. You're going to say $1,000 a month in rent, so you're clearing $300 in cash flow on that. How about it?
Yeah.
It gets better though on this, right? Because again, we're refinancing out of this. So your total costs were $73,000. You borrow $75,000, so that $2,000 spread gets to go right into your pocket at your refi settlement, right? That's why that refinance. We're creating a non-taxable event here. So this is essentially just free money that we've just gone ahead, put all this work and time, and we paid ourselves back and put a little extra into our pocket that we get to now go out and reinvest again and again and again and again and again.
So it sounds really simple. So what's attractive about this? Why am I doing this? It seems pretty basic. Where's the magic in it? I don't even know if I can get those numbers, right? Well, there's a couple of things to keep in mind. One, you may see people doing this that are getting more creative with how they're funding that. Maybe they're using a creative financing strategy. We went over owner finance last time. So if you want to get on that, go on the YouTube channel, watch that. That was a 2-hour conversation with people that are actually doing it and how they were doing it. So they were able to extend their refinance period to get more equity. So it penciled out when they exited, right? The reason I'm doing this is you want to do this 27K in total equity. This is where the magic happens, right? So what we're looking at doing is how do we avoid, the tax code is set up to incentivize investment and wealth creation. That's why it's there, or it's, whatever, your congressman was really good and carved out something there. But in general, right, the reason why there are tax benefits for business owners is because those are creating capital, they're increasing GDP if they're not just engaging in rent-seeking behaviors. Rent-seeking behaviors are when you see corporatism, it's a corporation working the refs or working society or an individual doing that to extract value without actually creating value, as opposed to you as an investor coming in and saying, hey, I'm going to put some skin in the game and I'm actually increasing the value of this property through my efforts and I get rewarded for it. Classic capitalism. We all love that, right? That's, I go and take on some risk and I get some reward. And that's how we actually have housing stock improve. Mm-hmm. If we try to do that on a governmental level or something, it would be so difficult to do. But by partnership with creative capitalism, we can get housing stock. We can create places that we'd want to live that we can rent out to people, right? The whole system will work fantastic. what I'm doing there when I have that 27K in equity is I can go out, I can buy a property, I can improve that property, and we can talk about multifamily. There's different ways, different strategies you can do that. I can increase that equity. And then when I refinance, I can pull equity out of that property. I can put cash in my pocket and I don't create a taxable event. And that's when things get magic, right? When we look at that like magic, anybody ever done the doubling strategy where you have a penny one day and you have 2 pennies the next day, right? That old riddle of like, which would you rather have? I'd rather have, $1 million now or just the 1 cent that's doubling because you have, it's something like, an obscene amount of money in a short amount of time. That does not work if you're paying 30% tax every single time. You don't get the exponential returns if you're doing taxable events. So the reason why we get outsized returns in real estate is because we're able to reinvest those dollars before taxes. And so that's the magic of this strategy is if I have an asset and the market goes up, it's pegged to inflation, everything costs more, man, I have 10% more equity in my property that I can tap as a cushion or I can go sell and liquidate. That's the magic of residential real estate.
Yeah, 100%.
So what do we do, Cory?
Yeah. So you just got paid to go buy a property, fix it up, refinance. You just got paid to go do this. You've got all your money back and you've got the ability to go do it again and again, again and again and again. You can just repeat this model forever. There's people that have been doing it forever.
The other thing that you do is you've got somebody, this is what's magic about the US. Just realize this. We have 30-year amortized mortgages at a fixed interest rate where I can go out, I can buy a house, I can provide a home to someone else, and they are going to pay that mortgage down over time. So I'm eventually a free and clear asset. And it's going to take a while for that to happen. But when I do that in the long term, that's when I really see cash flow happen. That's when I start hammering down. If I look at an amortization schedule is just when you have a mortgage, it's paying back principal and interest. If you look at the way it's weighted at first to pay back primarily interest, right? So as I get farther into the property and that money's going directly towards my principal, right? My rents, if you look at it on a graph, they're going to increase fairly stably. But when I look at the amount of how much I'm paying down, the amount of equity, my equity is going up like this. It's an exponential curve and what I'm paying. Does that make sense? So if I'm 10 years in, man, a lot of my payment that they're making is hammering down that equity. That's going directly to my net worth. So we've got some colleagues, Matt, who's like, hey man, every year my net worth now is increasing by 80,000. He's got a fairly modest portfolio because he started 14 years ago, right? Of just doing the work and buying this thing. And that's the beauty of what we're doing. And the property is increasing at a very modest amount at 4% a year. So I've got those two things happening to me, right? My property is going up 4% a year and they're paying my mortgage down. And that delta, that's the magic. That's how ordinary people are able to become millionaires if I buy a property correctly. I've got adequate reserves to ride out, the AC going bad, the roof going bad, and I'm screening my tenants correctly. This is a great strategy, and there's tons of tax incentives in terms of, we're not going to get into those, what you can do in terms of depreciation, writing all these things off, where even better, I can go use the money I'm spending on this property to offset my day job, to offset my income on my W-2. I can go look at the money I'm spending out over here and write this off and offset my income.
It's pretty sweet.
Yeah. I get really excited about this. Like this is ridiculous. We should just teach this every single month. You wouldn't show up, but this is the game. You should buy assets and hold them long term. And if you do that correctly and you hedge your risk into other assets, it's really hard not to build wealth.
Mm-hmm. Yeah, you have to try. The next one.
Cory, what'd you learn today?
I had some good takeaways on just some initial notes. I heard some good references on some property managed options. I mean, I heard at least some good arguments. I'm one of those like self-managed people, but I certainly heard some good arguments on the management side of things that I'll reflect on it, like as we continue to grow, because there is that balance of like time versus money saved.
Sure. I think it comes down to noise. Just how much we talk about how much noise do your assets generate and how much noise can you handle? When you're new, man, I have no money, so I have time and effort to put into this. But as I go on, what's it going to do to your marriage when you've got, this goes out Easter weekend and you're missing all the Easter photos and they weren't really on board with this whole crazy investing thing you have to do anyways, and you're out there plunging toilets or fixing AC systems, right? Like that's a real thing. You know, I'd say for us on selling residential property, what I have found when people are moving on a primary, they never remember that they saved money moving themselves. They never remember that. No one's ever talked to me years later about all the money they saved doing things themselves. I have heard years later about the horror stories about the emotional stress of doing it themselves, or, you know, like I was sleeping on the couch, right? Because we were getting snappy with each other because the moving, you know, all of this stuff. So just how much noise you want to put off there. Sure. Who's got any questions? Who's got any takeaways, you know, before we go network? All right, Jason.
Yeah, I'm just trying to follow the math. So the 700,
What's up? Right there.
the 700 cost for, I guess it was 1,000 rental. Is that,
Yeah,
that's how you had a
that's
300 profit or cash flow. But you didn't have your property management, which you're saying is almost
You're right.
necessary.
You're right. That's a cost
So
to like have to
10%.
factor in that. Again, like you can either choose to have the management in place or not. Like that is a trade-off.
We also have maintenance. 10% is kind of the standard, and then there's one more vacancy 10%.
Sure.
So that's everything.
Mm-hmm.
Yeah.
So who's using, in this market, who's using 10% vacancy, 10% maintenance as when they're running their numbers?
I'm not that high.
Who's using less on their vacancy number?
Yeah, me.
Right?
For sure.
Yeah, I would say I would feel very comfortable in this, and that's I'm glad you brought this up. We had another slide. I think we tweaked the thing we were playing with this that had those assumptions in there. So there's a rule of thumb that says you use 10% vacancy when you're running your numbers. We don't have 10%. At one point, we were 99% occupied, right? So I don't think a 10% vacancy number is like a realistic metric. You know, maintenance, that's going to depend on the property. I think it's good to have a set aside on that. Who uses 10% or who uses less?
I just use it just to be risk averse.
Yeah, 100%. What do you, so Jason says he uses 10% to run your numbers. Absolutely.
In reality, it's usually lower if you can manage well.
And it's lower because I've seen some deals, you know, where I'm like, oh, this is cash flowing. And then same thing, I sent it over and we add on an extra 20% and it doesn't cash flow at all. It doesn't make any sort of sense. Mm-hmm. But practically it's cash flowing. Anybody use a higher number for maintenance when they're looking at their assumptions? Like for maintenance, we're talking about setting aside, there's going to be some things that happen on the property. You're going to have a plumbing issue, right? You should be checking up and just touching that property on a consistent basis so you don't have deferred maintenance. Is 10% a good rule of thumb, guys? Yeah. On vacancy, if you're using less than 10, what are you using? I saw a hand raised. 5?
Man, like 3 personally.
3. Steven says 4. Cory says 3. Anybody a different number they're using? So we're running that number of like, I am planning on vacancy. I have not used 10% vacancy just because I haven't seen it personally. But yeah, that's why a lot of people are not running a buy and hold strategy. It's tight. So a lot of properties don't cash flow amazingly. Like Cory's rule of thumb, he wants 500 or 300 on there is because Cory, anybody else look at the MLS every night for fun? Yeah, this is all of the time. I was looking at beachfront property down in BRRRR yesterday, one does.
My team totally knows my 10:30, 11 o'clock at night, midnight, like emails that go out of just, hey, check this shit out in the morning, right? Look at this. Like, here's what I found when I was up at midnight, like looking at stuff. What'd you guys find? Yeah, I think great point. I mean, as far as like having some of those like carrying costs and like setting some of that aside that I didn't necessarily like include in here, I think it's really going to depend on if I just fix the property up completely, then I can typically go a lot lower on my expected like maintenance long-term on this. If I'm self-managing, I'm saving some cost there as well. That yes, there are some variabilities like into there. We're just trying to break down some like simple math of like what this exit looks like
No, I think it's
and
a
what
great,
that carrying cost in.
I
It's
think it's a great
very
one.
fair point.
Will asked me for that 3% you're setting aside, are you putting that in a separate reserve account?
Yes, for sure. So all of my properties have their own separate, I guess me personally, all of my own properties have their own, like an operating account and like a savings account that it goes into there, right? And so I do set a certain amount of money like aside every single month that just immediately feeds into that. I don't touch my cash flow from my rentals until that savings account for the property hits 10 grand. Once I hit 10 grand, cool. That's a nice nest egg. That fixes up. That's a major repair. That's a couple of tenant turnovers, so long as they didn't beat the crap out of the place, right? Anything more than that, realistically, is probably just going to be like an insurance claim. And so I'm just going to pay the deductible. It's going to be $1,000, $2,000. Cool. They're going to come in and insurance will take care of it from there. So I have that rule of thumb of like 500, like service the debt, $500 a month, because then I know I'm setting $6,000 a month, or six grand a year aside, like in that nest egg for that property. So it should take me like a year and a half to like hit that. Cool. Then I can start drawing it to go save for the next property.
And I'm so glad you asked that, Jason, because it's one of those, no, I don't do that. I execute the same exact thing you're doing in a different way.
Yes.
It's a hidden assumption in there, which is just, I am not using that active cash flow, right? That cash flow is coming in and I'm setting it aside. One of the underlying things I'd leave you with is just, before I'm running this play, I should be taking a look at like where I am financially. So if we went back to our very first questions, when we talked about, right, our initial assumptions, now that we've gone through this, how much free cash do I have, right? What's my long-term strategy? How comfortable I am with risk? It's going to be one of those questions. Here's some things to consider. Am I adequately insured? Do I have disability insurance? Do I have life insurance, right? Do I have short-term accident insurance, right? On my automobile policy, am I adequately covered? Now I'm going to go get assets where if I go hit someone and they're uninsured, right? Or am I just going to lose this in a case? And then do I have an adequate amount of reserve set aside? Like, do I have my emergency fund? 6 months, hopefully, before I get the right to go invest in real estate, because this, unlike fixing and flipping, isn't an active income play, right? If I've laid the foundation down, we're building wealth, we're not getting rich. Get rich, you might lose your shirt, when Dogecoin goes down. Not there's anything wrong with it, as opposed to maybe I bought Bitcoin because I believe in the platform and it's a long-term play, and I'm not worried about the markets. Same thing here. Like, if I've got those adequate reserves that I've set myself up in a way, and because you're running an agent investor play, or you're in here, I've got ways to drive my active income. Cool. Anybody got any other questions before we wrap up? Great. Who's ready to go?
Oh yeah, I have this. My QR code didn't work, but
Okay.
I'll include this as an email. I did have this slide. Grid partnered with the CE shop. So those of you that are realtors in here, or professionals looking for like continuing education, or maybe want to get your license, we partner with them to offer a 40% promo code. So if you are an agent, you really want to front load your CEs, go prepay for it now, like well in advance. You'll save 40%. I will make sure that goes out as an email.
That is the biggest discount that I've seen.
Huge.
I've used CE Shop for my education. I've used a bunch of them because I've been licensed in multiple states. What I'd say for them is, unlike some of the others that I cranked through, CE Shop was the only one where the examples they gave, I actually felt like helped me, even as an experienced realtor, where I was like, ooh, those are good questions. Like, I don't know. I'm gonna have to think about, right? Some of the math made sense. I learned a lot there. Cool. So here's what we want you to do. Go do deals. Go meet people. Just to cover, if you're look around at these name tags here, green means I have money, right? Orange means I have a deal or I'm looking for a deal, right? Purple is somebody here. If you need to find someone, you don't know who, if you're nervous about networking, find one of us that's got a purple badge. I'll put mine back on here. Cory will put his back on there. We're happy to make a connection for you. You don't have to do it on your own. If you didn't sign in, sign in. We'll follow up with you. We're happy to make an introduction. We know these people. We can point you in the direction of a good contractor or a good mentor if you're looking for a mentor. And red is someone that has experience to offer. That's going to be a contractor. It's going to be a vendor. It's going to be a real estate agent, right? Go find those, network, and do some deals together.
That's right. And we'll see everybody next month. We're going to be talking about where to find the money and how to be the bank. So if you if you're like me and typically looking for a lot of capital, that's going to be the one to go to.
Cory, will you show me the money?
No, I'm looking for it, man.
Show me the money.
That's right. They're right in the room.
Jerry Maguire. Thank you all for coming.
Thank y'all.